This diagram illustrates a typical manufacturing environment, with two service nodes on the left, information technology and custodial, and two production nodes on the right. The pulsing dollar amounts in the service nodes represent indirect overhead. Because these costs cannot be directly traced to specific cost objects on the assembly line, they sit in the ledger unallocated. External financial reporting rules dictate that we must move these service costs into the producing departments. This mechanical allocation is required to determine the final product costs, accurately calculate the entity's cost of goods sold, and establish the value of ending inventory. The structural complication arises here. Service departments do not exist strictly to support production lines. They also consume services from one another. As these arrows show, IT requires custodial maintenance, and custodial requires IT infrastructure. Resolving this interdependent cost loop requires choosing between three distinct mathematical models: the direct method, the step-down method, and the reciprocal method. Each formula forces a specific trade-off between computational simplicity and theoretical accuracy. This table details our initial data pool: $120,000 for IT and $40,000 for custodial. The direct method deliberately ignores mutual support between service departments. Instead, costs flow straight across, distributing cost pools using only the allocation proportions specific to milling and finishing. Because the service departments never interact in this structural model, the sequence in which you allocate them has zero mathematical impact on the final numbers. The direct method requires minimal calculation. However, by blinding itself to interdepartmental support, it introduces cost distortions into the final product valuation. The schedule demonstrates the step-down method, acknowledging partial mutual support through a sequential cascade. Top row, custodial services allocates 20% of its floor space directly into IT. Custodial pushes $8,000 of costs into IT, whose pool absorbs that hit, increasing to $128,000. This introduces a strict rule of closure. Once custodial steps down and zeroes out its ledger, it is locked. It cannot receive any future allocations back from IT, regardless of how much IT service custodial actually consumes. This unidirectional flow exposes the method's main vulnerability. If we start the cascade with IT instead of custodial, the final cost distribution dropping to the production lines changes entirely. The step-down method serves as the standard practical compromise. It captures a portion of the circular departmental support, offering more structural accuracy without requiring complex simultaneous algebra. This matrix introduces the reciprocal method. Custodial consumes 4% of IT's output. We calculate fully reciprocated costs using linear algebra. We define each department's total cost, then substitute the custodial equation into the IT equation. IT's fully reciprocated cost finalizes at $129,032. Notice that this fully reciprocated number is artificially higher than the actual pre-allocation ledger cost. It mathematically inflates to account for the continuous, infinite feedback loop between the two departments. By fully resolving true interdependency, the reciprocal method eliminates directional distortions. It sacrifices computational simplicity to serve as the rigorous gold standard of cost allocation. The overarching mathematical model, whether direct, step-down, or reciprocal, can be further refined by adjusting the allocation base itself, using either a single or dual rate. A single rate allocation blends fixed and variable costs into one blanket application. This approach penalizes steady production departments by saddling them with overhead fluctuations driven by temporary usage spikes in other areas. This table details the dual rate method, decoupling cost behavior. In the allocation to milling, variable IT costs are driven by actual short-term usage, measured in technician hours, while the fixed investment is allocated separately based on long-term capacity, measured by CPU cycles. Isolating these drivers ensures a production line absorbs only its calculated share of fixed overhead, protecting its margins when variable usage spikes elsewhere. This variance matrix compares the final overhead totals mapped to the milling department across the direct, step-down, and reciprocal methods. The visible delta between these figures proves how the choice of accounting mechanics dictates the real dollar product costs. This specific fact pattern is exactly what you will encounter on the CMA examination. You are provided with the pre-allocation overhead, the budgeted usage across multiple departments, and a strict prompt demanding a specific allocation sequence. Professional examinations require the mechanical fluency to execute these distinct algebraic rules rapidly and accurately under timed pressure. Mastering these allocation methods allows you to mathematically defend your overhead distribution, ensuring the strict accuracy of the firm's cost of goods sold and the integrity of its external financial reporting.